Namaste and welcome to a presentation on budgetary control. Budget is a plan. It is a guidance document. It is always prepared ahead of the time frame to which it pertains. It is prepared and approved in advance. And it is always in the background during the course of the budget period as a reference document. And it is a quantified document which contains details of projected income, projected expenditure, and also the funds required to be deployed during the period. And essentially, it is a financial document of inflow, outflow, income, and expenditure. And the whole purpose of preparing it is to achieve and exceed it. It is subsidiary to the objects of the company. The company or the business always aims at maximization of profits through resource management aimed at optimum utilization of resources. It is a reference document, and anything which enters the budget as income or expenditure, it is after a lot of studies of interrelationship of income and expenditure, and therefore budget also facilitates setting of standard costs over a period of time. Usage of budgets in the course of business operations to achieve the main objective is known as budgetary control. Effectively, directing the resources of the company towards optimization by use of budgets, and the process of doing it is called budgetary control. And budgetary control essentially involves three standard steps. One is establishment of budgets. Means it is just like having a game plan for every entity in the organization. Particularly the executives at various levels of the organization as per organization chart. And what a budget indicates? It indicates the specific responsibilities of every executive. He is given the resources, he is given a plan, the plan is a budget. It is his obligation and responsibility to achieve the budgets. Therefore, the first stage is establishing the budgets as per the organizational setup. Second is, it is not that you make the budgets and leave it to itself. It is a process of continuous comparison. For example, if the budget is for 12 months, there should be a review very regularly, say fortnightly, monthly, quarterly, or half yearly, so that there is a review and comparison to find out where are we as compared to our target. Are we far away from it? Or if we are too close to it, does it mean we have set our budgets at a lower level? Then it has to be made realistic and challenging. And therefore, the process of comparing budgeted results with the actuals so as to make the corrective action, to make use of better resources, is the second stage which we consider. And as we do it on an ongoing basis, we always ensure that with the corrective action, the budget is made realistic and it is achieved. And the achievement of budget is also due to fine tuning on the way towards the end of the budget period. We have to take corrective action. For example, if the budget expects a particular action to be taken, but there are no sufficient resources, but there is a better way of achieving by taking one more action, those decisions are taken in the course of comparison and finding out a solution. Essentially, budgetary control involves usage of budgets in the process of achieving the business objectives by establishing budgets, by their continuous comparison with the actuals, and taking the necessary corrective action in time. The time is the essence of the entire transaction in this case. The budgetary control process needs to be supported by all resources which are involved in the process of use of budgets, which are set very scientifically. And we call the essentials as prerequisites. And the first prerequisite is, since budget is prepared for each responsibility center, because you prepare a budget and give it to one particular office and that becomes its responsibility. When we say office, office is a responsibility center which is defined in the organization chart. Therefore, the first and foremost requirement is the organization should have a proper chart of responsibilities manned by a person who is qualified to take up the challenge and deliver on the promise. In addition to organization chart, each position in the organization chart is populated with the most befitting person, and that particular position has to have well-defined objectives, plans, and policies. There should be absolute clarity as to what is the empowerment and what is the deliverable, and they have to be well defined. Once that is done, that helps budgetary control. And as we saw, budgetary control is monitoring on a regular basis. Monitoring requires recording of actuals, and for recording and reporting on the information, we need to have an efficient accounting system which is online. Whatever is happening has to be reflected in the accounting records, and that should be a part of management information system. Therefore, for budgeting, right from the day of preparation till the end of receiving the results, we should have an efficient accounting system. And it is always give and take. There should be top to bottom and bottom to top flow of information on a regular basis. Only then you can understand the realities of running a business, grasp the constraints or the limiting factors, take immediate decisions, and for that purpose there should be always easy and natural flow of information between various levels in an organization, so that every budget of every position is supported by each other by transparency and strength of data. And it has to be, it is not that you just make a budget and give it to people. It has to be built from bottom up. The budget has to be achievable. It is not just a target given to go and get it. It is not an autocratic way of management. Business has to ensure that every resource that is available is used to its optimum level. For that purpose, we need to have a complete process scientifically defined and explained with a document. It should be a continuous process of review and readjustment, and the budgets have to be achievable. It should be a challenge, but at the same time, it should be realistic. And that is a prerequisite of budgetary control. In addition to this, whoever is a team member, unless he actively participates in the working of the budget system, success will not be that easy. It is therefore essential that we have to first sell the idea of budget and make it willingly accepted by every team member of the organization. And for that purpose, it has to be properly explained, and it has to incorporate the objectives of every entity in the organization. A budget which reflects the aspirations of the organizations and the individuals comprising it. It will be willingly accepted and supported at all levels. When you say willingly accepted, that ensures it is on the auto mode. There is no need for a close supervision from a third authority. Everybody is self-supervised. Now, with these prerequisites, budgeting will help us control the process of our journey towards the achievement of corporate goal. The budget, when it is prepared at the corporate level, we will have a summary of the budget. And the summary of budget takes care of all functions, and it will be just like a cash budget, which gives a overview of the entire operations of the company under various functions worked in detail for each of the functional budgets. And the source for every budget is the first component, which is sales or production, marketing and manufacturing. Now, this will be the starting point. The whole activity of the company will be based on what is budgeted as sales target for the year. Based on sales target, we will come for production target. And a similar terminology may have to be used for a service industry. Therefore, the first budget is a sales or production budget, and that will be followed by what are the materials required to be procured. And this takes care of the opening stock, closing stock, bill of materials, consumption required, and therefore how much to be purchased, when to be purchased, in what quantity. That talks of the material purchase. Similarly, for manpower resources, there should be a personnel planning, not only in terms of the resource content, but also in terms of the financial incidence. It is a labor budget of the company. And material, labor will be followed by the expenses, direct expenses and overheads. When we talk of overheads, a budget for manufacturing overheads, a budget for administration overhead, a budget for selling and distribution overheads. That way, we will be taking care of men, materials, and all the related expenses pertaining to them under these budgets. That will be followed by how much we have to spend on the capital expenditure, which is to be recovered on a deferred basis. And capital expenditure may be on fixed assets, which are of a massive nature, or fixed assets of a medium term nature. And all capital expenditure falling under the fixed assets, plant and machinery, land, buildings, software, hardware, furniture, vehicles, all these are taken care of by giving a time value for every amount to be spent thereon. And every company will have some investment on research and development, and particularly in case of pharmaceuticals, the research and development cost will be one of the flag bearers of the company. That way, if we talk of a cash budget or a master budget, which is a summary of all these budgets, we will have functional budgets for various things as we have detailed herein. We can have a view on what is the nature of a budget. When you prepare the budget for a specific period and for a specific level of activity based on the past data, it will be fixed or rigid budget. Rigid may not be the appropriate word, but it is a fixed budget for a period. Budget of sales for a company for 2020. And how is it prepared? It is prepared for a fixed volume of activity. We want to achieve 100 crores of turnover. And once it is there, and if it is prepared with a scientific study and in-depth analysis, it remains almost unchanged for the whole year or for the period. You won't be changing the budget component every now and then, although review is a part of budgetary control. It is almost fixed and it might be reviewed exceptionally. If there is a total change in the circumstances, take the case of COVID-19. Ahead of it, you must have planned for 1000 crores of exports. But when the whole situation has changed, you might revise it in the background of the change in the circumstances which are exceptional and which could not be foreseen at the beginning of the budget. To highlight, a fixed budget is as good as unchanged throughout the course of it for achievement, except for fine tuning. But it can be totally changed if there is a situation which is exceptional. Similar to fixed budget, we have flexible budgets. If the market keeps changing and the order flow keeps changing for products, the capacity utilization of the company will undergo change. Therefore, where the product mix is interchangeable based on a fluid market, it is always possible to have a flexible budget. They say, okay, if this product is manufactured at 80% of capacity, 70% of capacity, 60% of capacity. When you prepare budget for different alternatives of capacity utilization, different levels of activity or volume of output, it is called flexible budget. It is not that it is a loose budget, but it provides for a norm depending upon which level of operations is taking place. And flexible budget always has at the background the study of fixed and variable costs and the cost volume profit relationship of marginal costing. Flexible budget is also made use of side by side with the fixed assets or independent of fixed budgets. There is a third level of budget, zero-based budgeting. Invariably, what happens is budgets are always based on historical data. Past behavior is used to project the future. But if you don't have a past behavior, but you have to continue with your activity, then you have to set up a budgeting system which meets the requirements of business, which doesn't have a backup of the past data. Therefore, every activity in the business becomes a challenge and it needs detailed study and approval at every stage. Zero-based budgeting means a budgeting system which doesn't have any backup data, but which involves responsibility at every stage, and every money that is spent under the budget needs to be reviewed and approved before going ahead. And there is no base. No base means zero base. That doesn't mean you will get money and you can keep on spending. No, every amount that you spend, you do the process of budgeting on an ongoing basis, applied where output cannot be specified as a function of input for the simple reason you don't have precedents. And it requires each cost element to be specifically justified. And it is always done at the very senior levels of organization. Zero-based budgeting is handled by the most competent and experienced people, because you have to take spot decisions after studying the entire process and taking responsibility. Therefore, fixed and rigid budgets and flexible budgets are an order of the day. Zero-based budgeting is a virgin area where we enter into a new space. We will enter with our expert people, give them authority to carry forward, forming their own budgets and being responsible for everything that is spent, where there is lot of uncertainty and where there is no backup of past experience or precedence. Therefore, zero-based budgeting is an exception. It is not a rule. We have 4 illustrations which we will be looking into to cover the budgetary control. First one is a flexible budget. It's an example of June 2019, a problem wherein we are given one level of activity and we are supposed to budget for other 2 levels also. It is simple, but this is the standard template which helps us, where we always put it in the way of capacity, direct material, labor and expenses, overheads variable, overheads fixed. And how we proceed should follow a standard template. Let us get going. SBT Limited, a newly established manufacturing company, has an installed capacity to produce 1 lakh units. It has got a capacity to produce 1 lakh units of a consumer product annually. However, its practical capacity is only 90%. Means it is operating at 90% of 1 lakh, that is 90,000. The actual capacity utilization may be substantially lower as the firm is new to the market and the demand is uncertain. Agreed. The following budget has been prepared for 90% capacity utilization. Whatever is given is for 90% capacity utilization. Particulars are: direct materials rupees 12 per unit, and we are manufacturing 90,000. You have to remember this. The following budget has been prepared for 90% capacity utilization, means 90,000 units. 12 into 90,000 units is 10,80,000 is the value. Direct labor 8 rupees, 8 into 90, 7,20,000. Third, direct expenses 5 into 90, 4,50,000. Then comes the overheads. In overhead, he gives how much is variable, how much is fixed. Production overhead is 10 rupees per unit. 40% is variable. 40% of 10 is 4 rupees. 4 into 90, 360,000. If it is 40% variable, 60% is fixed. We have to post that also. 60% of 10 is 6. That way, we have taken care of 10, 4 plus 6 into 90, 4 into 90, 360, 6 into 90, 540. Then comes administrative overhead, 5 rupees, 100% fixed, means it is not entering into variable, it is coming here fully. 100% of 5, 5 into 90, 450,000. Selling and distribution, 6 rupees, 50% variable and 50% fixed. 6 rupees 3 is variable, balance rupees 3 is fixed, into 90, 2,70,000, 2,70,000. Now, at this stage, we have put all inputs into the 90% utilization. And what we need to do, you are required to prepare budgets at 70 and 80%. What we have received is for 90%, we are supposed to prepare for 10% below and 10% above, 70 and 80. Let us complete this. 3,60,000, 2,70,000. Now we calculate the values which we have already done. Once we do that, we strike the totals. Total variable cost is from direct material till the all variable overheads, 28,80,000. Our production is 90,000. And fixed cost also, we calculate the total. We have highlighted this to say they are fixed, 12,60,000. Once that is done, the total cost is F equals B plus D, D and B is 41,40,000, and we can derive per unit. 90,000 dividing 28,80,000, we get 32. Rupees 32 is the unit variable cost. Similarly, fixed cost at the capacity of 90,000 utilization, 12,60,000 divided by 90,000 is 14. 32 plus 14 is 46. This gives you variable cost, unit variable cost, fixed cost, unit fixed cost, total cost, unit total cost. This is the standard template. Now attending to the question. Question says prepare it for 70% and prepare it for 80%. It's simple. If it is for 90,000 for 90%, 70%, the units will be 70,000, 80% units will be 80,000. And we have got the norm for per unit, what is a variable. And in case of fixed, per unit for budgeting is not relevant. What is relevant is the absolute amount which we have derived, which will continue at the same level, 70,000. And we multiply 70 into 12, 840, 70 into 8, 5,60,000, 70 into per unit 5, 3,50,000, 4, 2,80,000, 2,10,000. In case of fixed, whatever amount is there fixed, it will remain fixed till it is 100%. Whether you operate at 70% or 80% or 0%, your fixed overheads remain the same. Therefore, we copy it to the other levels. Same logic we apply to 80%. Once we post these figures deriving of the per unit, as you will see, per unit variable cost will remain the same for all levels because they are variable directly proportionate to the unit. Whereas fixed amount remains fixed at 12,60,000. Since the capacity varies, 12,60,000 divided by 90 is 14 per unit. 12,60,000 divided by 70,000 is 18. And 12,60,000 divided by 80,000 is 15.75. And we add up B plus D to derive the total costs. The question asks, you are required to prepare the budgets at 70 and 80% levels of capacity utilization, giving clearly unit variable cost. We have calculated that. Unit fixed cost, we have calculated that. And we have also calculated total cost under various heads at all levels, all the above levels. At various heads we have given at individual levels, and that answers the question in full. The second illustration will be on differential costs. We will take it up. It is once again from June 2017. When you say differential, it requires two levels. When you compare the two, you will get the differential. We will see the problem. A company is at present working at 90% capacity, producing 13,500 units. Its operation involves flexible budgeting control system. Following figures are obtained. Let us get going. 90% operation, its capacity is 13,500, and we are given figures pertaining to two levels of operation, 90% and 100%. Sales is 15 lakhs and 16 lakhs. Fixed expenses 3,500,000, 3,600,000. Semi-fixed expenses 97,500 and 1,500,000. Variable expenses 1,45,000, 1,49,500. Units made 13,500 and 15,000. And it says labor and material costs. If you look into here now, you have to look into how we present. We started with sales. We have fixed expenses, semi-fixed expenses, variable expenses, but it doesn't contain the major item, which is direct material and direct costs. It says labor and material costs per unit are constant under present conditions. Where is it? It has to be derived. How it has to be derived? It says our profit margin is 10%, means out of my sales, if I remove my profit margin of 10%, balance is cost. Out of the balance costs, these are the costs given. If I deduct these costs from the balance, I will get the material. This is exactly what we are going to do. If we look into profit margin is 10%. My sales is 15 lakhs, profit is 10% out of it. My sales is 16 lakhs, profit is 10% of it. Means my cost of sales will be sales minus profit margin, 15 minus 1.5, 13.5, 14.4. I have got other expenses. This is the total cost of sales. I have got expenses other than material and labor. I have already posted them. My total expenses other than materials is 5,43,000, 5,50,000. Now, for me, the basis now is 90. I have taken that. Direct material is 13,50,000 minus 8,07,000. Sorry, minus 5,43,000. That is the direct material which I am getting. Once I get this, we derive our total cost. What is the total cost? Total cost is 543 plus 807, which is nothing but 13,50,000. 13,50,000 divided by 13,500 is my total cost per unit. And what is my direct material and labor component is 8,07,000 divided by 13,500. My material cost is 59.78 and balance is my other expenses. And if I take my total expenses and derive my per unit sales realization, 15 lakhs divided by 13.5, which is nothing but 111.11 is my sale price, per unit sales price. What the question asks here, you are required to determine different cost of producing 1,500 units. We have got 90%, 13,500. We have got 100%, 15,000. There is a difference between the two levels. Difference is 1,500. And what the question asks us further is, you are required to determine differential cost. Let us take the differential cost. Variable expenses. Differential cost is 5,43,000 becomes 5,50,600 in terms of these three expenses. Therefore, differential cost is for 1,500 units. The cost differential is fixed expenses goes up from 3,500 to 3,600, 100 rupees. Semi-fixed 97,500 to 1,500, 3,000. Variable 145 to 149. Total expenses which are differential is 7,600. And material, once again it is a variable expense. Here we have found per unit 8,07,000 divided by 13,500. Our material cost is 59.78. If I am going to calculate material cost for 1,500, there is no change in it. 59.78 into 1,500 is 89,667. 59.78 into 1,500 is my differential cost. In that case, what is my differential cost? All put together without profit. Here I have to recover 7,600 towards my incremental expenses, differential cost, and I have to recover my regular material and labor cost of 59.78 per unit. When we put these two, my total cost for the 1500 units is variable expenses, fixed expenses, semi-variable expenses plus material. 89,667 plus 7,600, 97,267 is the expenses that we incur between these two. For 13,500, this is the total, and for 15,000, this is the total. Difference between the two is differential cost. For export pricing under marginal costing, we try to recover minimum of the incremental cost or differential cost or marginal cost. These three are the same. When it comes to an export order, he says, what would you recommend for export price of 1500 units if overseas prices are much lower than indigenous prices? The prices may be lower, but we need to cover at least our differential cost. Our differential cost is 97,267. 97,267 divided by 1500 is 64.84. Therefore, we can answer them that since we have got additional capacity between 90 and 100, we can produce at an additional cost of only 7,600 of expenses, and we have to recover the full amount of variable material cost and labor. We can sell at 97,267 and we can recover at the rate of 64.4 for the export order, just to keep the capacity fully utilized. But the price has to be slightly 64.84 plus whatever profit available in the market. But the rock bottom is 64.84. And that is how you are required to determine differential cost 1500 units by increasing capacity to 100. We have calculated that. It is differential cost 7,600, 59.78 into 1500 is 89,667. Minimum export price is equal to differential cost 97,267, and the price will be 64.84 per unit for 1500 units. And our next illustration will be based on the production cost. It is from December 2019. Quite interesting. The following data have been compiled from TTA company regarding the budgeted and actual production of green tea packets for 6 months ended 30th June 2019. Now here you have to see the problem talks of budgeted and actual, and it is asking us to prepare a budget for December 2019. You have to understand one issue here now. You are given the past, you are given the present actual, you are to talk of the future. The question doesn't expect you to do anything as regards the budget. It talks of the future. It says use the actuals and prepare the budget for the future. There may be one issue where we may use the relationship. Therefore, when you prepare the template of yours, you have to prepare the template not to post everything. There is no need to post budget of the current year. I am supposed to post the actuals of current year and budget for next year. That point you have to keep in mind. Then you will ask a question, why these details are given? These details are given for the sake of establishing the relationship of expenses, which we should use in the course of preparing the budget. As we will proceed, we will get to know that production actual is 50,000 units. Materials consumed is 1,89,750, and it is by using 55,000 kgs at the rate of 3.45. Then in case of wages, the amount is 2,44,500 at the rate of 1.63 on hours. What is the hours? Wages at 3 hours per unit. 3 hours into 50,000 is 1,50,000 hours. 150 into 1.63 is 244,500. Third is variable overheads. Incurred is 1,25,000 and it is incurred based on 2.5 rupees per unit. Units are 50,000. Deriving these things makes a lot of sense to understand the relationship. And it says fixed overheads. Fixed are 1 lakh rupees. Means totally we have incurred as per the actuals of 6 months 6,59,250 and we know the relationship between the three. And we can also derive based on the 50,000 what is the per unit cost under each element. 1,89,000, this is per unit. This is per element of item, hours, units, kgs, etc. This is 3.45 per kg into 55,000 kgs. We can derive these individual unit-wise rates. This takes care of the first part. Then comes the second part of it. During the budgeted period is the next period, which is 31st December 2019. Production is expected to go up to 60,000 units. We are going to produce 60,000 units as compared to 50,000 of the immediate past. Material required is expected to go up to 65,000 kgs. Here it was 55,000 kgs for 50,000 and here it will be 65,000. Okay, we make note of that 65,000. The prices of materials are expected to increase further in the same manner as they had increased over the budgeted price. What was the budgeted price here? Budgeted price was 3 rupees per kg. Actual was 3.45. Means it became 3.45 for a budgeted price of 3. Means there is an increase of 15%. 3.45 over 3. What is the current price? Current price is 3.45. What it says is 3 became 3.45 and 3.45 will go up. 3.45 will go up the same way as last year. Last year means it is 15%. 15% of 3.45 we will get the new price of 3.965. This we have to understand clearly. The prices of materials are expected to increase further in the same manner as they had increased over the budgeted price. Then labor charges are expected to increase by 50 paise per hour. Per hour last year we paid 1.63. This year we are paying 50 paise more. Means we are going to pay 2.13. And though efficiency is expected to decline by 20%, means whatever we did last year, those hours are 20% less productive, means it has become to 80%. Last year we used 3 hours. 3 hours per unit. Today 3 hours has reduced productivity by 20%, means 3 by 0.8. 3 divided by 80% into how many units we are going to produce? 60,000. 3 divided by 80% into 60,000 is going to be 2,25,000 units. We know the price. Then labor charges are expected to increase. This we have taken care of. 3 by 80% into 60,000, 2,25,000. Then variable overheads are expected to increase by 10% over June 2019. June 2019, the prices were 2.5 per unit variable overheads. It is going up by 10%, means 2.5 into 1.1 means 2.75. And Fixed overheads are expected to increase by 20% over actuals. Last year's actuals was 1 lakh. It will go up by 20%. Therefore, it becomes 1,20,000. Once you post these things, it is as good as the problem is solved. 3.965 into 65,000 is 2,57,888. 2,25,000 into 2.13, 479,250. 60,000 into 2.75, 1,65,000. Total cost is 10,22,138. We just derive the rate by using the quantity of 60,000. Each unit wise, what are the rates? And our total cost is coming to 17.036. And the question says you are required to prepare production cost budget for 6 months ending December 2019, which we have prepared the budget giving element wise using the relationship and giving the total cost at the end of it also. The last illustration will be under sales overhead. Let us take it. It is a December 2017 question. A cost and management accountant that you are of MJK Limited, you are required to prepare sales overhead budget for the months of January, February and March. One thing you have to remember, these are simple things. It is only a matter of classification and tabulation. Which column has to come where and how should my template look like? Data is given. What we are doing is whatever is given on the month, we are putting from vertical to horizontal. And later it is only a matter of posting. We have to first understand how should my table look like to answer the question. Expenses per month are 2,500. Per month means advertisement. Estimates are given for January, February and March. Then salaries for sales department is 5,000. Expenses of sales department 1,500. Counter salesman salaries and dearness allowance 6,000. We just post it, and the presumption here is that expenses per month, it is fixed for 3 months. Therefore, for each month we make the posting. Then commission to counter salesman is 1% of their sales. Traveling salesman's commission is 10% of their sales. And expenses 5% of their sales. Where are sales? The sales during the period are estimated as under. Just a matter of posting. January, February, March, counter sales, sales. Now interrelationship, commission to counter salesperson 1% of counter sales. Traveling sales expenses and traveling sales commission, these are linked to traveling sales. We do that. It's only a matter of posting. 1% of 80,000, 1,20,000, 1% of 1,40,000. Then 10% of 10,000, 15,000 and 20,000. 5% of once again the same amount. And we strike the total, and you have got the question. Prepare a sales overhead budget for months of January, February, March. Simply, it is a matter of conceiving the design of the template, which is important, and the flow has to be easy and it should look right, answer all questions. And we have answered the question of preparing a sales overhead budget. We have got total sales, total expenses, and that's it. We have thus gone through flexible budget, differential cost budget, production cost budget, sales overhead budget, and hope you enjoyed the presentation. Thank you so much. Thanks a lot.